Okay, so here we are. This is the second lecture on Chapter 12. And Chapter 12 is on the economic collapse of 2007-2008, as well as a wrap-up of some of these economic principles. And, the purpose of my lectures is to give you an overview of the material, and the book is to give you the details. So there's lots of detail in these lecture slides, so I'm going to kind of rush through them. But before I even get started with the slides, there's one thing that I've just recently come to realize or understand, that we've been talking here about the difference between Austrians and Keynesians throughout this semester. And the Austrians, of course, believe that economic growth comes through saving and then investing that money in good investments that will grow the economy. The assumption here is growth. Now, we had a whole chapter on growth. And, I explained to you that if we do not grow, then we have less tomorrow than we did today because things deteriorate. Now, what I've become to realize, however, is that there's a movement that is not in favor of growth at all. It's not a matter of which policy will bring about, the best growth and the best standard of living for the average person, but really the two schools of thought today is really one of pro-growth and one of actually no growth, or the official word is actually degrowth. There's a big movement afoot today that, in fact, there's even a manifesto that you can see online called Degrowth Manifesto, and I'm going to present a bit to you, but this actually makes a lot of what's happening sense, because if you take Europe, for example, Europe has got a very sluggish economy, and yet they have not, same with the United States, and yet they have not put forth fiscal policies that will better grow the economy. Instead, they've relied on monetary policies. But and you look at that and you say, well, don't they know that if they changed some things fiscally and made it easier for people to save and people to invest, that would grow the economy? But that's an assumption that is really false, because many of the leaders of the world are actually in favor of less, not more. They're in favor of a smaller economy and an economy that will grow less, or not even grow at all. In fact, they want to cut production. They want to shrink the size of the economy as much as 90%. And I've got some videos here that will just give you an overview of this, because this, a big part of the first this chapter, at least the first part, we talked about the benefits of growth. But this will give you a different insight into what's happening in the world. This is called Degrowth, a vocabulary for a new era. It's just 3 minutes long. I've got actually two of these, but they're both very short. But this will give you an idea of what I'm talking about.
2014 was a watershed year for economics. First, a baby-faced Frenchman shocked the world, claiming that inequality is increasing and that capitalism is to blame. And now, the latest literary sensation from the once dismal science has gone even further. Degrowth, a vocabulary for a new era. A book that is against growth is being hailed as the credo for a radical rethinking of society. From the bottom up. One after the other, Famous economists and politicians are endorsing the thesis of the book. Growth is no longer sustainable. A new economy is necessary. Even politicians from unexpected corners have been quick to jump on the degrowth bandwagon, even those who have passed away. But amidst the enthusiasm, the authors are quick to stress that degrowth is not about declining GDP. It is about building a totally different way of life. Part 1 introduces lines of thought, explaining some of the complex theoretical models. Part 2 explains the core ideas and concepts, including chapters on conviviality, dematerialization, simplicity. Part 3 focuses on the concrete actions through examples of how citizens and communities are building new democratic societies from below. Part 4 brings it all back to international movements and philosophies that are natural allies of degrowth. Degrowth, a vocabulary for a new era, your guidebook to a degrowth transformation, taking place everywhere.
What a good idea! I had thought of it!
And let's see, this one will explain it a little more.
Have an OJ business. You buy oranges, sell juice, and create waste. And your super smart assistant figures out a way to make less waste and more juice.
So now that you can get more juice with fewer oranges, you charge less in order to attract new customers. Maybe you expand your stand into an OJ empire, serving the entire nation with your preferred pulpy product. Pretty quickly, you end up with even more waste.
Orange farmers are expanding production, and the people saving all the money on cheap OJ can use that cash on plane tickets, cheeseburgers, and more orange juice.
That's why everybody needs a lot of this. Oh, me.
This is the story of growth. But instead of orange peels in a stand, we have carbon emissions in the economy. As better technology and more efficient processes allow us to get more energy from a given amount of dirty fuel, energy then gets cheaper. And in turn, families increase their energy use. Since the products made in factories can be produced with less fuel, all sorts of goods get cheaper. And when people can buy more, they do.
Very serious people guffaw at this inherent contradiction,
Pointing out that GDP is just a measure of value, not a measure of resources or stuff. They say that through efficiency, we can continue endless compound growth with less environmental damage. But so far, that hasn't come close to happening. In the last 2 decades, the only year we've reduced carbon emissions is 2009, which also happens to be the only year the world's economy didn't grow. But growth helps fight poverty, right? Not exactly. In the US, GDP has tripled in the last 40 years.
but the bottom fifth of American households haven't gotten a raise, and the median hasn't cashed in on that growth either.
So who's making more money as the national income increases?
The top 5% of earners, the 1%, and the top 100th of the 1%.
As for global poverty, you can argue that growth causes it to some extent. GDP counts money spent on new products in the economy, so one sure way for less developed countries to achieve growth is to literally sell things that used to be free.
When communal orange groves that provide for everyone are privatized by a corporation and the juice is sold back to the community by the plastic half-gallon jug, that's considered growth.
You could argue that the community doesn't have to buy orange juice, but if this were to happen with communal water sources, I think you see the problem.
Or, when healthy communities get sick and have to buy expensive patented medicines, That counts as growth too.
Basically, GDP measures costs, not benefits. But we can't just turn around and decrease the GDP, since growth-based economies tend to either grow or collapse. Half a year without growth is officially called a recession.
Degrowth offers an entirely different economic possibility.
Degrowth is about reducing our society's metabolism, slowing down the rate at which we use up all the oranges, guzzle down the juice, and shit out rinds all over the land. Instead of cutting costs to profit and grow our OJ stands, we make sure all our workers are paid well, or even better, own the company and farm cooperatively. So we gotta charge a little more. But we spread the wealth around a little better so no one's excluded.
We compost the peels for the community orange grove and take Fridays off to spend time with our friends and family.
In other words, we don't have to devise eco-alternatives that accommodate growth. Instead, we can focus on improving quality of life. Now, there's no set script for degrowth.
It might be putting caps on resource use and auctioning off limited permits to mine fossil fuels and distributing the proceeds evenly to everyone.
Or it can be a job guarantee program to make sure everyone has meaningful work, even as the economy produces less stuff overall. People can be paid for restoring ecosystems, growing organic veggies, or taking care of their aging grandparents.
Degrowth is urban gardens, open source software, and community credit unions.
It's cooperatives for childcare and healthcare, emphasizing voluntary work to meet local needs. Degrowth, above all, is a cultural shift. The growth at all costs mindset divides surplus production into wasteful, individualistic consumption and reinvestment for growth to make an even bigger surplus next time.
Meanwhile, 2 billion of us aren't even meeting our basic needs.
In Degrowthtopia, we share the surplus to live better, make rad art, and drink the finest hand-squeezed orange juice at our wild parties.
He smells Marxism.
Exactly.
How would you refute this as a master economicist yourself?
How would you? Well, there's two. I mean, I've got my personal opinions as an economist. I watched several videos. I showed you these two because they're very short and they kind of give you kind of a very brief overview. But the idea is to it actually, the movement actually favors depression. Well, the word I read in their materials is recession, but they put a caveat on that, and this movement says that, well, we want a recession, where everything is slowed down and we have less, but it's a planned recession. Let's see, they use the word, I think they use the word managed. It's a managed recession. So it all involves more planning. Of course, what did Frederick Hayek warn against?
Central planning.
Central planning. According to Hayek, and I'm not taking a position here. What I'm trying to do is make you realize that there are two viewpoints, and there's a contest here, and actually the no growth or the degrowth camp is actually gaining and is dominant over the growth segment. That most of the leaders of the world are actually in favor of degrowth. That's why they're not willing to put fiscal policies into effect that will stimulate growth, because they don't want growth. But why do they rely on monetary policies to kind of try to monitor things? Because they want the shrinkage to be managed, to be planned. Okay. If you don't understand this, it's hard to understand what's happening in the world today. But and to bring this point, I didn't have the Wall Street. My Wall Street didn't come this morning, so when it doesn't come, I always just read it on my iPad. But there's an article here about one of the persons who's running for president, and it says here. that he calls for climate change. He calls climate change the single greatest threat facing our planet. Now, the whole point of this degrowth movement is that it actually goes back to the ideas of Robert Malthus, who was an economist back in the 1800s, and he claimed that because population increases geometrically, but the food supply only increases arithmetically, that eventually we're going to, as we grow, we're going to outstrip our ability to feed everybody. Now, do you understand what arithmetic and arithmetic growth is 1, 2, 3, 4, right? The other growth is 2, 4, 16, 32, etc. That's geometric growth. So it's the idea. I mean, the basic idea was that that we're going to reach the limit to our ability to grow, and we're going to outstrip the world's resources. And that's basically the idea of this degrowth movement, that we have to slow down growth, that we have to shrink, because if we don't, then we're going to outstrip the ability for our ecosystem to sustain us. That's really the basic idea, and that's where these ideas come from. Like this person that I don't want to be political here, so that's why I'm not using his name, but because it's not the person that's important, it's just the idea. But he says the greatest threat facing our planet is pollution. He's proposing a 40% reduction in carbon emissions by 2030 and an 80% reduction by 2050. So the idea here is to reach this developing world level of CO emissions. He proposes a carbon tax, ban on all offshore drilling and fossil fuel leases on federal land, stop dirty pipeline projects, ban natural gas, oil exports, and force states to ban fracking, ban mountain coal mining, impose new fuel efficiency standards of 65 miles per gallon on automobiles, and spend massive federal dollars on subsidies for wind, solar, and geothermal biofuels. And that says this will require a government-mandated, top-to-bottom remake of the U.S. economy and maybe the American way of life. So, and then it says, welcome to the revolution. And really, this is we are in the midst of a revolution of those who support growth and free markets and that sort of thing, and those who are in favor of actually a shrinkage of man's footprint, it's called, on the ecosystem. Well, so that explains a lot. Y'all find that interesting? Any questions?
Can you make the argument that, I guess, the people for growth versus the people who want to shrink the carbon footprint,
Yeah.
one kind of have a very short-sighted view, while the others try to keep the planet going? Because global warming has been scientifically proven that. Global
warming is just what I'm trying to present to you is that global warming is just a slice of the whole concept. It goes much deeper, and I don't want to get into whether global warming is a fact or not. The point is that there is a movement out there, and this is all I really wanted to make you realize, is that there's a movement out there that where these environmental laws, against pollution and all that. And we've talked about this before, that if it weren't for government, we'd all be choking to death from pollution. We do need a certain amount of government regulation. All economists, would agree with that. But it's only a part of a total movement. There's something called, if you look up the Degrowth Manifesto on the internet, it'll give you all of their platform. Or if you look up the Georgia Guideposts, which is a big stone monument in Georgia, it explains the basics of their core beliefs. And one of their core beliefs is to shrink the world population by 90%. Now, they don't say how they're going to do that, but that's part of their manifesto. So, anyway, any other questions? Of course, if this does lead to slower growth, that means fewer jobs. So who in the short run anyway, who bears the greatest brunt of this philosophy?
Regular people?
Well, no, you do. Your generation, right? Because if there are fewer jobs when you graduate, then it's your generation that is going to bear the greatest brunt, at least in the short run. But according to the degrowth philosophy, we're going to have people who only work 20 hours a week instead of 40 hours a week, and only work 4 days a week instead of 5 or 6 days a week. But they're going to be paid just as much as. Now, how they're going to accomplish that, they don't say, but that's part of their goal. Anyway, let's get to these slides, because I'm not going to, again, I'm just going to try to give you an overview. There's certain, let's see, slideshow from current slide. Certain concepts that you have to know. One concept is the idea of a derivative. Now, the derivative market is a $600 trillion market. It's by far the largest market in the world. And I've explained to you that even though the Federal Reserve has created money through a process called quantitative easing, that we've not gotten inflation because a lot of that money has not gotten into circulation in the American economy, but gone elsewhere. Well, where is elsewhere? Well, one of the elsewheres is a derivatives market, which is an international market. So what is a derivative? The word derivative comes from the word derive, and what it means is that something has value because its value is derived from something else. All right, and so that if you give a piece of paper value based on the value of something else, then that piece of paper is called a derivative. Now, I've explained this to you once, but I'm going to explain it again because it's maybe such a foreign concept. But if you and I got together and we made a bet on some future event, and we wrote down on a piece of paper exactly what our agreement is, and we wagered a certain amount of money, like $10,000, then on that future date, whoever is on the winning side of the bet collects the $10,000 from the other party. So, whoever owns this piece of paper on that future date will collect X number of dollars. So all of a sudden, this piece of paper has a value of $10,000. Well, what gives that piece of paper the value of $10,000? Because the value is derived from the bet that you and I made that someone is going to collect X amount of money in the future. And this is what people with money do. They simply make bets, and you have two sides of a bet, and the winner of the bet, and the bet can be on anything. It could be on the value of one currency relative to another. Like you and I could enter into a derivatives contract, and you might say that a year from now the euro will appreciate relative to the dollar, and I say that the euro will depreciate relative to the dollar, and so now we have a derivative. And someone is going to win and someone is going to lose a year from now. All right? So that's what a derivative is. Okay, now what is securitization? That's another concept that you have to remember, and I forgot to turn on my... okay, this is chapter 12, the second lecture, and we're talking about securitization. And what is the purpose of securitizing? And this is something I explained last time, but again, I'll just repeat it very quickly. But securitizing is the practice of taking debt instruments and putting them into a bundle and then selling off bits and pieces to investors. Like last time I explained to you that when you go to the bank and you take out a mortgage, well, the bank will simply sell that mortgage to someone else, usually Fannie Mae or Freddie Mac, and then Fannie Mae and Freddie Mac securitize these mortgages, you see, and then sell off bits and pieces to investors. And that's called securitization. All right. Now I've got a short video for you that that will explain. There's two videos. There's one that's embedded in these PowerPoint slides, and there's another one on the on your website. But they both explain in different ways what securitization is. But the idea is that you have this box. Okay, now this box is made up of debts that we have securitized. Now, what gives value to this box? Well, what gives value to this box are the payments that people have made on their mortgages. So every month people pay on their mortgages, or it could be other types of loans. It could be car loans or other types of loans, credit card loans, but anything can be securitized. So, but the idea is that when people make their payments, then this money goes into this box, and then from this box it is paid out to investors. Okay, so this is part of modern finances. Now, when you really break it down, and this is something that this video will show you, is that we have sliced and diced this it's called a collateralized debt obligation, or a CDO. We have sliced and diced this CDO so that there are different tranches, and there's a high tranche, middle tranche, and a low tranche. And those in the high tranche are people who have been willing to accept a lower interest, but they are the ones that, if there are defaults, that they will be paid first. And then there's the low tranche of high risk, more high risk debts, that people can receive a higher interest, because there's an indirect relationship between risk and interest. The more risk you're willing to take, then the higher interest you can earn. So the lower tranche pays a higher interest, but when people default on their loans, then it's the people in this lower tranche who don't get paid. Okay, so see, as people default on their loans, certain people that's part of the CDO still get paid, but other people don't get paid, or get paid a lot less. But that's part of the game, because the people who are not paid, or who were paid a lot less, realized that they were buying from the lower tranche, and the reason they were getting the higher interest is because they were the ones who were bearing most of the risk of people defaulting on their loans. Now, what happened back in 2007 is that there were so many people, for different reasons, but there were so many people defaulting on their loans that almost everyone, and sometimes everyone, simply didn't get paid. I mean, the lower tranche didn't get paid, the middle tranche didn't get paid, and even the higher tranche, it was a complete meltdown. And even those people didn't get paid. So we had almost a complete economic, or at least a financial collapse back in 2007, 2008. Now, another thing that you should, I'm trying to hit the highlights here, but the other concept in all of this is what's called a credit default swap. Now, what a credit default swap is kind of like buying insurance. There were many retirement funds and such type funds that required the managers of the fund only to buy AAA rated bonds. Now, we have three credit rating agencies, Standard & Poor's and Moody's, the two main ones, and they rate debt instruments according to the risk factor. And a AAA rating would be the highest credit rating, meaning that, there's almost no chance here of default. So many retirement funds required their investment managers to buy only AAA rated bonds. Well, if we've got these collateralized debt obligations, but a lot of the a lot of the mortgages or other type loans as part of the CDO have been very of a high risk nature. We like in the mortgage market, we lent money to people that it was obvious from day one that they would never be able to even make their first payment. We had even things called Alt-A loans or liar loans, where it was legal for people to go to a bank and lie on their loan application. That was totally legal, because we said, well, you can lie. I mean, you can be making, let's say, $20,000 a year flipping burgers from McDonald's, but you can tell us that you're making $100,000 a year, and we'll accept that, and we'll lend you money based on $100,000 income instead of your $20,000 a year income. I mean, can you believe that this was actually a type of a loan? It's called an Alt-A loan. And so if we're going to lend money to people with this kind of situation, it's obvious that they're going to default on their mortgages. So and other type loans. So how is it that we could have these CDOs that were made up of simply junk, and yet rate the whole thing as AAA, so that countries and retirement funds could actually buy these CDOs? Well, the way that it worked is that there was the CDO bought a credit default swap. Now, here's how a credit default swap works. There are certain organizations that would sell insurance, like IGA, and IGA, which is the largest insurance company in the world, had a AAA credit rating. All right. Now, the CDO people would go to for example, IGA, and they would say this is the arrangement. They would say, we will pay you X amount of money up front, or we'll pay you, semi-annually or annually, but we'll pay you a bunch of money if you're willing to take the risk of default on these loans. So in other words, what a credit default swap is that we have swapped the chances of defaults onto a third party. And so that the CDO people would buy like this insurance from AIG, and if there was no defaults, then AIG would simply keep the money. But if there was a mass default, then the CDO would not have to take the loss, but IGA would pay these investors the money that was owed them. Does that make sense? I mean, actually, this is a pretty good, and so many of what happened back in 2007, 2008, the practices actually made a lot of sense. I mean, this whole concept of credit default swaps was first originated by J.P. Morgan, and at that time they were used for, J.P. Morgan Bank used them for loans that really had a high credit rating. And later on in the game, when other banks took this idea, but instead of insuring loans that had truly high credit ratings, they would insure just junk. And J.P. Morgan actually was quite alarmed by the fact that this idea that they came up with was actually being so misused in a bad way. But the history is that the CDOs could sell junk to people and call it AAA because they had bought credit default swaps from IGA, and IGA had a AAA credit rating. All right? So this is one of the things that helped lead to a complete economic collapse, because what happened is that IGA, actually it was a department of IGA, this insurance company, the financial division of this company, that they insured a whole lot more than they had resources for. So it's like any other insurance. I mean, an insurance company can insure something, but the insurance only goes as far as that company's assets. So if an insurance company sells too much insurance, and especially if they take too high risks, then when there is a collapse, well, the whole thing collapses because the insurance company doesn't have enough money to make good on the arrangement. And that's what happened. See, IGA went bankrupt. Back in 2008, IGA went bankrupt as well. All these financial corporations went bankrupt and only survived because the government simply created money in most of it and simply bailed these companies out. So there's three concepts here. The first concept I just explained to you is what securitization means. The second concept I explained to you is what a CDO is. And the third concept I explained to you is what a credit default swap is. Okay? Okay, so let me, what happened here? Let me see, what is the collateralized debt obligation? I just explained that, what that is to you. A type of structured asset whose value and payments are derived from a portfolio of fixed income assets, like people paying on their mortgages, is a collection of streams of income under one roof. Streams of income. People paying a mortgage, money goes into the box, and then money goes out of the box to investors. And how are CDOs structured? Hundreds of loans are put into a pool and then divided into different tranches, it's called, according to risk level. And what gives CDOs value? The money that flows into and out of a CDO as people pay their monthly installment loans or retire the loans. And this is the short video that will show you how it works. I wonder if I can get to it. Let me see. Maybe not.
we've seen that an investment bank can buy a bunch of mortgages, which essentially makes them the lender to the homeowners, and then it could stick those mortgages inside of a special purpose entity, and then it could sell the shares in that special purpose entity, and that these shares would be called mortgage-backed securities. And let's just say, just for the sake of argument, when it sells the...
Now, they're called mortgage-backed securities if the loans are mortgage loans, but they don't have to be mortgage loans. They could be any type of loans. In fact, what happened is that Fannie Mae and Freddie Mac, sole purpose, these are two agencies that were brought into existence by the government, and their sole purpose was to buy mortgages from financial institutions. And there was the implied guarantee, and actually it turned out to be an actual guarantee, that the federal government would back up Fannie Mae and Freddie Mac if there was ever a financial collapse, which is exactly what happened. The federal government did bail them out as a result of the financial collapse. But because of that guarantee, other banks could not compete with Fannie Mae and Freddie Mac in the mortgage market. But they realized that you can securitize any type of debts. Like the latest thing is the securitization of student loan debts. With student loans being about 1.2 trillion, your student loans are securitized, okay? And so other banks got into this practice of these collateralized debt obligations, not so much with mortgages, because they couldn't compete with Fannie Mae and Freddie Mac because of the implied government guarantee, but they could in other areas that Fannie Mae and Freddie Mac, like student loans, that Fannie Mae and Freddie Mac had nothing to do with. But if you're talking about these loans as part of a CDO, if these loans are mortgages, then the CDO is called a mortgage-backed security.
Shares, it sells them at $10 a share, and it promises dividends that's at $10 a share, the equivalent of an 8% yield. So maybe the homeowners here are paying a higher than 8% interest. Some of them default once you average everything out, and the investment bank keeps a little bit for itself and to do all the operations and all the overhead, and so it can actually give the investors an 8% yield. This might be good for a whole class of investors. They might like the safety profile, the risk profile of this special purpose entity, of this mortgage-backed security, and they might like the return, and they might go for it. But there might be a class of investors, maybe very risk-averse investors like pensions, that says that this mortgage-backed security is too risky. They've looked at what we're holding, and they're like, hey, some of these are subprime mortgages, some of these are shady, some of these are to risky borrowers. I don't like where this is going. And even if they can't look under the hood to see what this is, the investment bank might have hired a ratings agency, ratings agency, to essentially look under the hood and tell investors what's there. So the ratings agency might look at this special purpose entity and look at these securities and say, look, I would say that these securities should be rated double B. So not super safe, but not super risky either, but for pensions, that is not safe enough. Now, on the other hand, you might have people who want more risk. So you might have, maybe there's some risky hedge funds, and not all hedge funds are risky, but let's say that there are some risky hedge funds, and that they say that this yield is too low. Yield is too low. And the investment bankers, they're very creative people. They say, well, look, here's some people who want to buy securities, but these securities are too risky for them. And there's other people who want to buy securities who are able to take on more risk, but they say the yield is too low. So instead of losing out on these investors, why don't I just split up this special purpose entity in a different way? Why don't I split it up into tranches? So instead of all of the securities being the same, why don't I put them into classes? So why don't I put them into classes? And they're so often called the senior tranche, the mezzanine tranche, I'll just write mezz for short, or the middle tranche, and then the equity tranche. And the way it works, in a mortgage-backed security, everyone gets paid the same amount. In this situation, when you split it this way, the holders of the senior tranche securities are going to get paid first. Only when they're made whole are the owners of the mezzanine tranche securities going to get paid. And only when they are made whole will the owners of the equity tranche security will get paid. And this scenario right over here is called a collateralized debt obligation, CDO. And it's really a derivative security from the mortgages. We've sliced it and diced it in a slightly different way. Now you might be saying, how does this solve the problem? Well, now the ratings agency will say, well, look, if the senior people are going to get paid before everyone else, then I'm going to give them a higher rating. And they can even get insurance on this and get a credit default swap, and then maybe they'll give it a AAA rating, which means that the pensions can now buy the senior rated CDOs. But they'll pay them less interest. Maybe they'll pay them 5%. Maybe the mezzanine, they get paid next, they'll get maybe still a double B rating, and they'll get the 8%. And then the equity tranche, they'll get a higher interest, so they'll get say a 15% interest in exchange for being the last person to get paid. And maybe they don't get any ratings at all, so you could almost view this as a junk rating if you want to view it that way. But that makes both people happy. Pensions get something safe, lower yield. Hedge funds get something risky, but it has a higher yield.
So that helps explain what a CDO is. Let's see. So I've already talked about Fannie Mae and Freddie Mac. Its purpose is to expand the secondary mortgage market. Now, see, when you go to the bank and borrow money, that's called the first market. Now, when the bank then sells your debt to someone else, that's called the secondary market. All right, and so Fannie Mae and Freddie Mac's sole purpose is to buy mortgages on the secondary market. Okay, so authorized by Congress in 1972 to purchase private mortgages on the secondary market to compete with Fannie Mae. All right, so what are some problems with securitizing debt? The complexity can limit investors' ability to monitor risk and make it more difficult to standardize the market. See, this whole concept is really a brilliant concept, and in many aspects it makes a lot of sense. But some of the failings of this whole concept of securitizing debt is that, see, for example, if a bank lends an individual money, like on a mortgage, and if that bank were to keep that mortgage, then the risk factor would be very easy to ascertain. I mean, the person who took out the mortgage, do they still have a job? How much do they make on their job? What is their past credit history? So it's pretty easy to ascertain the level of risk involved. But when you take thousands of these mortgages and put them into a CDO, then how do you ascertain the risk level? And that it becomes almost an impossibility. And that's why, because it was so complex, because we had this box here, it's called a CDO, that made up of so many different debt instruments, that they relied on these credit reporting agencies like Standard & Poor's and Moody's to ascertain the debt level. Or they relied on the credit default swaps that transferred the risk to one entity like IGA, and then the credit to ascertain the credit risk for that one entity was a lot easier than ascertaining the credit risk for thousands of different mortgages. Now, this is what happened back in 2000. All this took place in 2000, and then, of course, the collapse came in 2007, 2008. But these practices are very much alive today. This is all a part of modern finances. This is modern economics. Leverage, we've talked about before, the act of using borrowed money to make bets on some future event. Now, see what happened is, okay, let's say that that you and I come together and we make a bet on some future event, and we both wager, let's say, this $10,000. But now, with leverage, now what that means is, instead of using my own $10,000, I might borrow that $10,000. So I'm going to use someone else's money, and then I'm going to enter into this contract. All right. So that's what leverage is. If I use my own money, that would not be leverage. But if I use someone else's money, see, then that's called leverage, because I'm not doing it myself. I'm relying on the income, I'm relying on the money of some third party. So I'm leveraging what I can do. See, like if my net worth is only $10,000, then I can only wager $10,000. But if I can borrow $100,000, see, then I'll go and borrow $100,000. I may put $10,000 of my own in it, and then $90,000 someone else's. And then if I win the bet, then my returns are much greater than if I had simply used my own $10,000 to begin with. So if I use leverage, I can greatly multiply my returns on this bet. But what's the downside? Well, the downside is, I mean, if I win the bet, my gains are greatly multiplied. But if I lose the bet, my losses are likewise multiplied. Okay, so I can, since I borrowed $90,000 and I wagered $100,000, I can lose $100,000. Well, only $10,000 is mine, and $90,000 is someone else's. So the amount of, when you have leverage, when people enter into these financial contracts using leverage, it's like skating on thin ice. It makes the risk factor so much greater. And that's exactly what happened back in 2007, 2008. The fact that so many of these people who entered into these CDO arrangements used so much leverage that when things collapsed, and things collapsed because people stopped making payments on their debts, when the whole thing collapsed, then the losses were greatly multiplied. Okay, subprime mortgage is a type of mortgage which involved high risk to the lender, and in some cases actual deceit and fraud. See, what is an alt-A loan? I just explained what that is, like a liar loan. People could actually lie on their applications. That was okay, their loan applications. And policy of Greenspan, who was chairman of the Federal Reserve from 87 to 2006. The easy money policies of the Fed during Greenspan's tenure has been suggested to be leading cause of the subprime mortgage crisis. Easy money policies, meaning that we would lend money to almost anybody. I mean, if you were vertical, you would qualify for a loan. Why were the easy money policies of the Fed a factor in the mortgage crisis? People borrowed money to buy homes, the price of homes increased, equity increased, and many people borrowed against the home's equity. So not only did we make it easy for people to borrow money, and we lent them money that they could not afford, but because this encouraged so many people to buy houses, that the price of houses went up, and when the price of houses went up, their equity in the house went up. Like, if you let's say you buy a house and the price of the house is $100,000. So you borrow money based on $100,000. Well, the equity in the house is $100,000. I mean, if you can sell the house in the market for $100,000, then that's what the house's equity is. But if the price of the house goes up to, let's say, $150,000, I mean, that's what you could actually sell the house for in the market. then your equity in a house is no longer $100,000, it's $150,000. So you've got $50,000 more in equity, which qualifies you for a larger equity loan. So what people did is that they said, oh, well, we've got all this equity in our house, let's go borrow money against this equity. But instead of investing that money, they simply spent it on the cars and trips and things like that, and to live in the present better. But then what happened? Well, when the crash happened, housing prices collapsed. So what happened to people's equity? Well, it vanished, and then the bank said, well, since your equity, I mean, you borrowed money based on $150,000, but now your house is only worth $70,000, so we demand payment for all this money. And people said, well, we don't have money to pay you. And then the bank said, well, all right, just leave the house and we'll take over the house. And so that's what happened. A lot of people just lost their houses as the housing prices collapsed. Now, what was the Housing Community and Development Act of 1977? This act has gone through many revisions over the years. So it's 1977, 1992, 1999. So it's a little bit confusing, but the original Housing and Community Development Act was 1977, and the purpose of the act was that banks were required to make substantial loans to low-income persons, even with bad credit ratings. So you might say, well, why did banks lend money to people that it was obvious that those people would never be able to pay the money back? And part of the answer is that they were required by the government through this Housing and Community Development Act to lend money to low-income people with bad credit ratings. So these banks, in many cases, had no choice. See, why did Fannie and Fred defraud investors? And the same, to increase market share in the subprime loan market. Now, subprime, means lending money to people with high risk, and to meet the demands of the Housing Community Development Act of 1977. So, you see, the government actually required, like in this case, in the 1992 revision of the Act, Fannie Mae and Freddie Mac were required to meet the goal of 30% mortgages bought should be from low and moderate income families, and this was raised to 55% in 2007. So the government said, because you are we brought you into existence and we have some control over you, we are requiring you that by 2007 that 55% of the mortgages that you buy from banks have to be of low or moderate income loans. I mean, loans made to people of low or moderate incomes. So again, this was a government mandate. The government does this. Like the goal of the government was to put more people in houses. They thought, well, the American dream is for a person to own their own home, so we're going to pass a law that will make it easier for people to own their own homes. So their intention was that more people could own their own homes. And that's why these mandates. What pressure was put on Fannie Mae in 1999? The Clinton administration encouraged an increase in loan purchases stemming from inner city areas and pressed for an easing of standards in the primary mortgage market. So not only, by 1999, not only was the subprime market affected by this, but now the prime market was affected by this. In other words, these mandates from the federal government were now placed on prime loans as well as subprime loans. And what mandates were put on Fannie Mae and Freddie Mac in 2004? See, we're leading up to the collapse of 2007, 2008. They were required to purchase subprime loans from banks to the tune of $1 billion per week. So now, Fannie Mae and Freddie Mac are required by the federal government to spend $1 billion a week. Now that's a lot of money. $1 billion a week purchasing subprime loans from banks. And banks were required to, a certain percent of their loans had to be to low-income people who ultimately defaulted on their loans, which is the reason for the financial collapse. Securities Exchange Commission, responsible for enforcing the federal securities law and regulating the securities industry, okay. And in 2004, it allowed banks. Now, part of the problem back then was really rent seeking and the political influence that big banks and other big companies had in Washington, D.C. And many of these banks wanted to take more risk, but there were laws against taking risk in certain areas, at least up to a point. And so, like in this case, prior to 2004, the leverage the bank could use was only 12 to 1. In other words, for every $1 they had on hand, they could lend out $12. But banks wanted to use more leverage. Because remember how I explained to you how leverage works. And so by the practice of rent seeking and influencing legislation in Washington, D.C., they got the Congress to approve a capital ratio of 40 to 1. So now in 2004, instead of banks having to have $1 to lend out $12, now they only need to have $1 to lend out $40. So here we're getting an increase in the extent of leverage. Which firms benefited the most from these change in legal ratios? Goldman Sachs, Bear Stearns, Morgan Stanley, all these investment companies. None of them exist today except for Goldman Sachs. They all went bankrupt. And what happened in 2008? They all collapsed and either disappeared or were converted to bank holding companies so they could be bailed out by the Fed. See, there were laws that the Fed could only bail out banks. And many of these companies that I just showed you, these big financial firms, were not banks. They were investment companies. So in order to skirt under the law, what a bank holding company is that if a large organization that's not in the financial industry, not a bank, but they purchase a bank, so that bank is a part of their total business, even though it may be a very small part of their total business, they are given the designation of a bank holding company. And a bank holding company has all the protections that the bank has from the Federal Reserve and the government. And so that's what happened. A lot of these financial firms, they purchased a small bank, they became a bank holding company, and that qualified them for billions of dollars of bailout money from the government. Okay, let's see. I'm going to rush through this a little bit. Let's see. Now here's an interesting story. Angelo Mazzello and Countrywide. Angelo Mazzello is a person who started and grew this company called Countrywide, and Countrywide specialized in lending money to low-income people, and they were infamous for trickery or lying. I mean, they would take advantage of people in many ways, and they would convince them that you can afford this big mortgage, and we'll lend you the money. You can get into your dream house, and you can lie on your mortgage. You can in your application. You can do all kinds of stuff because if you're vertical, we'll lend you money. And you might say, well, why would they lend money when it was obvious that that these loans would go bad? Well, the reason is that Countrywide sold these mortgages. Well, who did they sell them to? To Fannie Mae and Freddie Mac. There was actually a partnership between Fannie Mae and Freddie Mac and Countrywide, because remember, Fannie Mae and Freddie Mac had mandates on them to purchase X amount of subprime mortgages. So Countrywide specialized in giving out subprime mortgages and partnered with Fannie Mae and Freddie Mac so that Fannie Mae and Freddie Mac could meet their government mandates. Y'all find this interesting? And see, what role did Countrywide Home play? Countrywide partnered with Fannie Mae and Freddie Mac and formed a reduced documentation loan program. Reduced documentation. That says just sign your name here, and we'll lend you a couple $100,000. I mean, just very simple. Anybody can get it. Countrywide found the customers, and Fannie provided the money, because Countrywide sold these mortgages on the secondary market immediately to Fannie Mae and Freddie Mac. And let's see. Yeah, we're getting a little. We're getting into a little. We're getting about to time to go here. I've already talked about what options are and shorting the market, hedge funds, derivatives instruments. So I've already talked about what a derivatives market was. See, I kind of got ahead of myself because I knew up here I'd run short of time. So anyway, I covered the basics of this anyway. You can get more details from the textbook. So this completes the course. I hope you learned something. Hope you keep up with things, because it seems like the world is changing so quickly, and yet we're all affected by these changes. So anyway, let's call it a day. And are there any questions, by the way, about the final exam or anything? The final, the date is the 14th, and it's the final exam is just like all the other tests. It's 50 questions, true, false, multiple choice. You take it on Blackboard, just like all the other tests. And by the way, the deadline for getting extra points on the Wall Street Journal group or the 10-point essay is a couple days after the final exam date. And I did that on purpose, because if you're short, 6 points, 10 points, 12 points after you take the final exam, after you've taken all 8 tests, you still have time to get the extra points to get you to the higher grade if you want it. All right?
The deadline for the final, the 14th?
Yeah.
Okay.
The final is the 14th, and then but the final, I'm giving you a couple, 2-3 days after that for the extra credit. Okay. All right. So, well, I enjoyed it, and I wish you all well in the future. So, let's call it a day. All right? Yeah. Oh, bye-bye.
Green is the new red. Set a speaker please.
Let's see. Let me
Half a century ago, your generation was worrying about the spread of communism. Now we're worrying about the spread of recession.